can we set my business up as a charity and I can still take all the money myself? People, they can make donations in exchange for services and now they get tax deductions too. No, 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 no. Hi, this is Jeff Marsacci, the Plain English Attorney, and welcome to the video. Before we dig into today's topic, please help us get out solid, accurate information on estate planning and Medicaid planning by liking the video and subscribing to the channel. Unfortunately, the algorithms just tend to favor videos that tell people what they want to hear instead of what is actually true. If you want us to get the truth out there about estate and Medicaid planning information, then please like the video and subscribe to the channel. Today we are going to talk about, should you start your own foundation or use a donor-advised fund? You've done well in life. Maybe it was a business sale, an inheritance, or just decades of smart savings, and now you want to give back, but you want to give back on your own terms. So the question is, do you start your own foundation or just donate something to like a donor advised fund? Now, both options are going to let you support the causes that you care about and potentially reduce taxes for current gifts as well as potentially estate and income taxes down the road. But they are very different animals. I'm saying this not just as an attorney who's worked in estate planning for decades. I also have a certificate degree in nonprofit management from Duke University, which is just kind of a fancy way to say, look, I've really looked at this issue and these issues. And I've also done a lot of volunteer work in my life, working with both charities, nonprofits, and other organizations. So let me walk you through the basics in plain English. So what exactly is a donor advised fund? Well, a donor advised fund is like a charitable investment account. So you're going to put money into it, get a tax deduction right away on the way in, and then you can recommend money grants to your favorite nonprofits and charities over time. So you think of it as a charitable piggy bank, but with some guardrails. You don't have to pick all your charities up front. You can take your time. The fund's managed by a sponsoring organization. Usually it's a large nonprofit or a financial institution, or it's specifically a foundation set up this way that handles all of the paperwork, the recording, the bookkeeping, the tax filings. They handle all of that stuff. And it's a simple, low maintenance, and relatively inexpensive way to do that. So even better, you can set things up now so that even after you're gone, your chosen charities can continue to receive donations automatically. So you can choose the causes, the organizations, and the donor advised fund keeps the mission going. No committee votes, no red tape, none of that other stuff that has to come along with it. All right, so what then is a private foundation? If you think it's important for educational videos like this to get out there, then please help us out by subscribing to the channel. Well, a private foundation is a whole new legal entity. Usually it's a nonprofit corporation or a trust. So you have to set this up and control it. Typically, there's registration with your state organization, and then there's federal paperwork involved. You decide who runs it, how they invest money and receiving grants and whatever. But with all of that control is coming a lot of responsibility, sharing responsibility, and a lot of red tape. So you have to file for tax exempt status with the IRS. So this is where we're getting to the difference between a nonprofit and a charity. Look, a nonprofit, you can just set up a nonprofit pretty easily. You're registering it with the Secretary of State or similar organization within your state. And basically it's saying, look, there's no shareholders. There's a board. This is all for money to go to charitable type purposes, but you're not a charity in yourself. Yeah, you don't pay taxes. You do have to report what money's coming in, but the shareholders don't get anything. So there are a lot of nonprofit groups out there that set themselves up as this nonprofit. But if people donate money, well, you're not a charity. You're just a nonprofit. They can't deduct those donations from their taxes. In order to do that, they have to get this charitable status with the IRS. And typically, a lot of states will just kind of go along with that. They may have some of their own requirements. It just depends on your state. You have to draft the bylaws or the trust agreement. You have to appoint a board of directors or trustees or have a vote on it. Do you have to deal with members who actually have some control, or is it just the board? You have to follow all of these self-dealing rules and payout minimums. So just to let you know what we're getting at with the self-dealing rules and payout minimums and things like that, I often get, well, hey, my business does this work, and I think it would be great if we didn't have to pay taxes. So can we set my business up as a charity and I can still take all the money myself? And now people, they can make donations in exchange for services, and now they get tax deductions too. No, 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 no. You can't do that. You can't also set up a nonprofit or a charity and then simply say, yeah, the exclusive services provider is going to have to be my business. So this is the self-dealing rules and other things you have to deal with. So you have to know those rules, and then you have to abide by them. You have to file an annual tax return. So that's a 990-PF, which is basically a reporting requirement. Even if you're not paying taxes, you still have to file that informational return. You also have to possibly hire staff, pay legal and accounting fees, and handle all that bookkeeping through that nonprofit or that charity. Here's something most people don't think about. Once you're gone, that board is in charge and they can change things. In fact, technically speaking, you're only one member in a board, and you have to have, I believe the minimum is 3. And even then the IRS kind of looks down on that. They usually want at least 5. You can't 100% control that. And so if this board, after you're gone, just decides to go in another direction, that's it. It happens. What you intended it to do isn't necessarily going to keep happening. So sometimes it's a gradual thing. Sometimes it's drastic. Either way, you're no longer in control. You're gone, and those wishes may not even survive. So what are some of these key differences between a donor-advised fund on one hand and a private foundation on the other? The setup. There's a lot of time spent, weeks, months, and sometimes just making sure everything's good, a year or more, to get a private foundation up and going. But a donor-advised fund, typically it's a couple of hours of paperwork with the donor-advised fund, making sure that everything's in correct order. Startup costs. Donor-advised funds, maybe there's some costs. It could be nothing. Potentially the costs come out of whatever the donation is that you're putting in, but sometimes these donor-advised funds have some costs associated with it. The maximum that is usually out there would be like $5,000. But if you're hiring professionals to help you set up a private foundation, you can probably easily look at $10,000 or more. Tax deduction limits. Well, all right, with a donor-advised fund, you can have like up to 60% of income, or up to 30% of income with a private foundation. And that's just the way the donations work. Look, I'm not going to get too deeply into that. For that, we want an accountant. Annual administration. For a donor-advised fund, it's really minimal on your end. It's kind of like you're getting the information from the donor-advised fund. And if you're donating money in, okay, that's something you bring to your accountant. If it's for a foundation and you're the person in charge, oh gosh, that's an awful lot of paperwork. You have to be in charge of making sure it gets done. Grant controls. Okay, for a donor-advised fund, look, it's recommended. A lot of clients want the ability to decide where grants are going, what organizations are getting it. But look, the organization, the donor-advised fund, can do that work for you. It's not mandatory. When it comes to grants coming out of a foundation, now you've got to have your process set up. You have to make sure that it's done the right way, that it's complying with conflict of interest rules, and there's checks and balances. I once worked for, yeah, well, I didn't actually work for the foundation. I was a member of a club, and the way they set things up, they basically were giving grants out to students, and they were just letting someone at the school decide who it was, no review of anything, no whatnot. It's like, whoa, whoa, wait a minute. You've got to have an actual process. The foundation has to make the decision. You can't just, well, teacher, you just decide what you want to do. Who do you want to give it to? And we'll just rubber stamp it. We're not even going to look at anything. No, you can't do that. So you have to have that full control. And you have to have the responsibility to make sure all of the conflict of interest rules and you've got a process in place that works. Public disclosure, well, it may vary as on the state level, but with the donor advised fund, it's just private. Now, when you're talking about a foundation, there's a tax return and it's public because it's for a charity. This foundation has all of that stuff available to the public. For legacy control, your charities are chosen in advance by you, so you can change that over time if what you're doing is donating it in over time. And then when you've passed on, okay, that can be locked in. Here's how it's going to work for the next 20, 30 years or however long it lasts. Once you're gone with the foundation, that board could change everything. So after death givings, it's going to continue. And again, depends on future boards with the foundation. So you also need to make sure that you're not forgetting about your will or trust in all of this planning. So this is another thing that people overlook. This isn't just about the money that you're giving away while you're alive. A lot of charitable giving comes and happens after death through your will or revocable living trust. You can leave a gift to your donor advised fund or a foundation as part of an estate plan, and that gift can be a game changer. But again, the outcomes are very different. If you leave money to your donor advised fund, then your chosen charities can start receiving funds almost immediately on your terms without court approval, without any kind of board debate. It's done. You leave money to your foundation, and it's up to the board that you've appointed to manage that legacy. If they stay true to your values, great. But if not, okay, you're not around to say anything about it. And you have to legally give them that kind of control. When a donor advised fund makes sense, okay, for a lot of my clients, when they call and they ask about setting up a foundation, we start running through this pro and con analysis. For their particular situation, they're usually leaning more towards a donor advised fund. So when do you choose a donor advised fund? If you want simplicity, if you want a quick tax deduction before the end of the year, this is definitely something that's easier. You're not ready to commit to specific causes just yet, or at least not long-term. You can change and update that. You want the giving to continue after your death, according to your priorities. If you want to avoid the legal headaches of setting up a foundation, and you don't need your name in lights on everything, look, a donor advised fund makes a lot more sense. All right, so when does a private foundation, maybe it's worth it? If you want full control over the grants, hiring, or the direct charitable programs, again, in conjunction with other members on this board. If you want to build a legacy that's going to carry your family name well beyond 20 or 30 years, something like the whole Kennedy family and the grandfather and him setting everything out and having that legacy forever, well, okay. At that point, you're going to be willing to put in the work. If you have some substantial assets where you could just hire people to handle all of this setup and the running and the maintenance of it out of your donation to the foundation, okay. So if you're okay with complexity, compliance, years of management, all right. If you want your family members actively involved in philanthropy and leadership, there are some interesting ways that we can work in conjunction with, say, a perpetual family legacy trust and setting up a foundation to work in conjunction with that. That's great, but it is very complex. but it's also a good potential teaching tool. Now, look, the bottom line, it's easy to get caught up in the idea of creating your own foundation. It sounds noble, powerful, prestigious, and it can be all those things. But make no mistake, it's a ton of work. Creating a foundation means managing people, money, regulations, and long term strategy. You have to build the structure, maintain it, and hope that future board members are going to honor your intentions. By contrast, a donor advised fund, it's a plug and play. The sponsoring organizations have already done the heavy lifting. You just focus on the giving and making it work in conjunction with your estate plan and leave the administration and legal stress to them. Now, both of these paths are completely valid, but one becomes essentially a job. The other's just a tool to get where you want to go. So if you want to make sure that your giving plan fits your overall estate strategy and you're in the North Carolina area, then please call our law office at 919-844-7993, and we can set up a discovery call and take a look at what works. So as I always tell my clients, please stay safe, plan ahead, and enjoy life. And whatever you do, make it a great day.